So hello my colleagues, and I hope everyone is well. So I received a couple of questions about chapter 11, some excellent questions, and I want to go over them in the textbook with you. First of all, the first one is, I do not understand why there is one formula on page 379, example 1110, used for short selling, which seems like borrowing money to me and is risky. First of all, you are absolutely correct about that. Short selling is risky, okay? And we saw that with GameStop recently, right? The shorts took a beating as the stock went up. You're playing with tremendous risk, okay? All right? Now, here's the equations in the example, okay? The student references example 1110, okay? And basically, you're going to short $10,000. You're going to short sell, which is selling stock you don't own. Hopefully that it will go back and you buy it back at a cheaper price, okay? And you buy it back at a cheaper price. So if you look here, you basically, here's the portfolio weights of Intel and Coca-Cola, all right? Now you'll notice for Coke, it's negative because you borrowed, you're short selling it. It still adds up to 100%. Now, I want to make something clear. They're using equation 11.3 and equation 11.8 as before. You see that in this example? So here's 11.3 and 11.8. So short selling basically increased the expected return here, but it also increased the volatility. So you can clearly see you can make money, but it's a lot more risky. So that was an absolutely correct statement that was made there. All right. Now, okay, and then proceeding with the first question, it says, and then a completely different derivation for short selling, right? Based on risk-free securities, used to calculate expected return for a portfolio that uses a margin, borrowing money and pretty risky. All right, so anyway, here's the section that the student is referring to. We might decide to borrow money, so if we are an aggressive investor who is seeking high expected returns, we might decide to borrow money to invest even more in the stock market, okay? Now, it doesn't have to be T-bills. You could just borrow money in general, and I've done this in the past. I've taken a home equity loan, okay, at 3%, assuming I was going to make more money in the stock market. So I'm taking a little risk there, assuming I'm going to make more than 3%. In this section, we will see that the ability to choose the amount to invest in risky versus risk-free securities allows us to determine the optimal portfolio of risky securities for an investor. All right, so here's an arbitrary risky portfolio with returns RP. Now, we have to look at the effect on risk and return of putting a fraction X of our money in the portfolio, and then we're going to leave the rest in risk-free treasury bills with a yield of RF. Okay, so here's the expected return. Now you can see here's the component of the risk-free of the portfolio that's risk-free, and here's the component of the portfolio, and they just solve for that in this way. They just rearrange terms there. I hope everyone's clear about that. So, but once again, the important point is they use the same equations as we saw previously. You see what it says here? Using equations 11.3 and 11.8, which is what they did previously. Hold on. Which is what they did in the previous example if we did not have a risk-free investment. Let me just go back for a minute. So you see in this example here, 1110, there was no risk-free securities such as T-bills, and they used equation 11.3 and 11.8. in this equation over here, they're getting the expected return, but they have to, again, they're using equation 11.3 and 11.8, all right? But there's now a risk-free component here, okay? So the expected return is the weighted average of the expected returns of the T-bills and the portfolio. Because we know up front from the current interest paid on T-bills, we do not need to compute an expected return for them because we're told that, right? All right. Now we got to get the volatility. So here's the volatility, and again, this is the same equation, 11.8, except now we have the risk-free component here, okay, which is right here. So basically, you can see this blue line here, which is the investing in the portfolio and the risk-free investment here, different combinations, okay? And it hits this point right here. So you have combinations of volatility, and so here we have combinations of volatility and expected return for different choices of the ratios of the risk-free rate and the other portfolio that's not risk-free. Okay. So if you look at the two equations we just showed, which are very similar to 11.3 and 11.8, if we increase the fraction of X invested in P, we're going to increase our risk, and you could clearly see the risk going right, the risk going up here, and our risk premium proportionally. All right, you see that, right? So here we are. Now we're here, we're buying on margin, and you can see what we're doing that. But you'll notice buying on margin, where our expected return is could be going up, but so is our volatility here, right? I mean, look at our volatility here. You see that with this blue line? We're on margin from this point on. Okay. All right. So I've kind of done this by borrowing money from the bank to invest in the stock market. All right. However, here is the efficient frontier of risky investments, so you can clearly see that if I'm not on margin, I'm okay up to here, and then up to here, I'm going to get a higher expected return for the same volatility I have here. So buying on margin may increase my expected return from this curve, right? From this curve. Okay, this is the inefficient frontier, okay? But here's the efficient frontier, right, of risky investments. So while this may increase my inefficient frontier, it still basically doesn't give me as much as my efficient frontier here. Okay. So I just wanted to make that clear. Okay. So definitely, borrowing at the is a risky game. So the blue line here shows the portfolios we obtain by investing X in portfolio P, and 1 minus X in the risk-free investment. All right. Investments with weights X greater than 100% require borrowing at the risk-free interest rate. Okay. Which is kind of what I did, right? The other question was, and I'm gonna have to jump ahead a little bit, was should one just skip those equations that we just talked about and use the capital asset pricing model equation and the beta of the stock? And you could do that, okay? You could basically do that. And again, you would use the capital asset pricing model for a portfolio, okay? So let me jump ahead here a little bit. And the efficient portfolio and required returns, and you can clearly see here we're calculating the beta of a portfolio, okay? And this is, I guess, equation 1119. So you can see now, here is the expected return. And you can clearly see here, we're using the beta of the portfolio. All right, so that's what's going on here. And technically, you should use the capital asset pricing model. Okay, it's the easiest thing to do. So the beta of a portfolio is the weighted average beta of the securities in the portfolio. Okay. Now here's the beta. Here's the beta for so the beta of a single security, which is shown right here, is the measure of the volatility of that securities reference to the market portfolio. Now the market portfolio is typically the S&P 500, okay? So the beta of a security measures the amount of the securities risk that is common to the market portfolio, which is the S&P 500, okay? And here's how you define beta. And, you know, this is a lot of math here. I don't want to drive you crazy with that. And now a portfolio, it'll be just the weighted average of the securities in a portfolio. And for the S&P 500, the beta is always considered 1, okay, by definition. So I don't want to confuse anybody about that. All right. So the next question was the comparison to market portfolio in example 1116, which is right here, is confusing. When I am looking at a stock to purchase in general, what market portfolio in real life would I be comparing that stock to? And as I previously mentioned, you want to use this S&P 500 as your market portfolio, and that's given a beta of 1, okay? And I think they might have mentioned that in your book somewhere, that the S&P 500 has a beta of 1. All right, but I would use this. This is the standard equation you should really worry about. Okay, this is the capital asset pricing model for equation for the expected return. Here's the beta of each stock. Here's the risk-free rate. Our market is typically the S&P 500, and this is the return on the S&P, which you can get right off the web. Okay. So again, that's what I would do. So that's the market portfolio. All right. Okay, so the next question was, what is the difference between the capital market line, or otherwise known as the security market line, right, and the Sharpe ratio? There's 3 terms here. There's the capital market line, the Sharpe ratio, and the security market line. All right, so first of all, the Sharpe ratio, which is equation 1117 in your book, okay, is going to give you, and it's very similar to the capital asset pricing model, it's going to give you the expected return of a very specific portfolio, in this case, all right, that you set up, minus the risk-free rate over the standard deviation of the portfolio. So this is giving you your excess expected return above and beyond the risk-free rate per unit of standard deviation, okay? And the higher this number, obviously, the better, okay? So you want something with the highest Sharpe ratio. Now, it looks very similar to the capital asset pricing model, okay? And it is in the following sense. The portfolio with regard to the capital asset pricing model is the portfolio of the S&P 500, okay? So I'm going to shoot ahead there, all right? So let me go there. So here is this equation, which is the capital market line, okay, which intersects a curve here, okay, of the efficient frontier of all risky securities, okay? And you'll know the intersection point here, right, is basically the efficient point, the efficient portfolio. And again, this is basically the Sharpe ratio. Okay, this is the Sharpe ratio here. And you notice it does go through. It does go from the T-bills on up. So this is pretty much a graph of the Sharpe ratio. All right. So it's kind of like the slope. You can see the slope of this is the expected return over the volatility. So for the most part, that tangent line is the same exact thing, and it's giving you the point of basically the best return, right? The highest return for the level of volatility here. So so that capital market line is pretty much what that Sharpe ratio is showing you. So again, you'll notice it says the market portfolio is the efficient portfolio, and that would be the S&P 500. So now we're replacing the S&P 500 in the Sharpe ratio. Okay, the Sharpe ratio was more general, but here now they're basically you're putting in the the S&P market portfolio. So this pretty much is a specific way of looking at the Sharpe ratio. Okay. All right, so I hope that helped. If you have any other questions or if I'm not clear about anything, let me know about that. This is a very difficult chapter, and I don't expect anybody to know and learn all the mathematics here, okay? I think the capital asset pricing model is probably the most important thing you would want to learn in this chapter, okay? So please concentrate on that.